Good morning, everybody. This is Brad Reed. I am a real life trader, and I'm here reminding you to be good. And by good, I mean get out of debt, achieve your financial dreams, and give generously to your community. Have some wonderful blessings today. I have my financial advisor here today, Stacy Andries. And in order to give Stacy the most amount of time, I'm going to wait to say hello to my dad and Art, who are also here. I'll say hello to them a little bit later. But Stacy, thanks for taking care of a big part of my family's retirement. Really do appreciate the great work that you do. And with that, I will turn it over to you. Good morning.
Good morning, Brad. Thank you very much for giving me the opportunity to be here. Good morning, Trading Room. Again, my name is Stacy Andries, and obviously being able to do some stuff for Brad, he feels that it's valuable to be able to share this information. There's not a lot of people out there doing what I'm doing in the financial services industry and sector. And I kind of have a unique reason for doing that, but because I don't have a ton of time, I will get to questions on the back end. I'm going to hang around for most of the morning if possible. So if we don't get the questions here, I'll answer those throughout the morning through the text, if that works for everybody. So one of the things that really motivated me to pursue a career in the financial services industry was a result of what I had learned about students that I had worked with in the past and why they'd been wanting to learn to trade. Why were they coming to us to trade at that point in time in their life when a lot of them were in their golden years and should have been out there enjoying retirement, but so many of them had just real legitimate money and cash flow concerns because of what had happened to them through the past 15 years, since 2000 in the markets. And one of the things that I know I always tried to hammer home, I know Brad and Jeremy do the same thing, is that they talk about when you are trading that you want to manage your risk, that you need to protect yourself from massive losses so that you have more money for trading tomorrow or next week. And the problem that I saw, and maybe what some of you have experienced, is that few, if any, who put themselves out there as financial advisors or an investment advisors ever really do this. I've been there, I've had my accounts hammered like many others, and I didn't like the results. But at the same time, I also didn't believe that it had to be this way. And so really that led me on a quest to find a better investment solution. And it took me a long time to do that because it's not well known. But what I'm going to share with you today is really a result of what I found. And so really what every investor wants when it boils down to it is they say, make me money and don't lose. The problem is that most people over time have been led to believe that there is only one way to invest. You invest in the market, and then when you're invested in the market, you live with the inevitable ups and downs. If you talk to a typical financial advisor or planner after 2008, they probably said to you, well, Mr. Client, I know you're concerned about where your account is at right now, but you need to remember that we are in this for the long haul. The market will come back, quote unquote, I hope, and will make you money, I hope. But you're going to have to ride this out. There's going to be ups and downs. This isn't going to be the last one, but you will get to where you want to be. The problem is, I was not seeing that with the students that I was working with. And I believe that the majority of the industry in this regards is living in the past and really has not adapted to address the growing concerns of those who are in retirement, those who have retirement just around the corner, or even those that maybe still have 20 and 30 years to go before they're at that point. And so I just want to share with you a little bit about what we're doing and what sets us apart from the rest of the industry. So, although it may appear that when you talk to different people and with everything that we're being fed, that there's as many ways to manage money as there are birds in the air or fish in the sea, it boils down to, when you strip everything away, there's two basic strategies. There's strategic and there's tactical. Strategic, basically, it's been promoted by the mutual fund industry for decades. And this is what's referred to as your buy and hold. It employs a more traditional allocation based on general diversification principles. We're going to hold stocks, mutual funds, fixed income that meet your risk tolerance. They say that long-term performance is going to be achieved by maintaining a somewhat static asset allocation, and then it's going to fully participate in all the upside, which is true, and that's great when the market's doing good. The unfortunate thing is that when the market does poorly, there's increased volatility and negative performance. You also get to live with all of that. The second strategy is tactical, and this is the approach that I have been taking and what I went on a quest for. I'm going to talk more about it in a minute, but this is something that has been used by institutions and large accounts for decades now for sophisticated investors. And until recently, it really has not been available to the average everyday investor, individual, like you or like me. So the interesting thing is that over time, really both have worked, but at very different times. If you look at the 90s, buy and hold worked great during that period of time. You took $100,000 at the beginning. At the end of that decade, it had turned into $423,000 and had an average annualized return of 14.5%. That's pretty amazing. You couldn't find a stock during that time, for the most part, that was not doing well. But if you take a look at what happened in the next decade, same buy and hold strategy, results were significantly different. $100,000 over that 10-year period had grown to just under $80,000, or maybe I should say shrunk. You had an average annualized return of 2.23%. So yeah, worked great in the 90s, buy and hold, but it did not work so well the last decade and even the last 15 years. So what then is tactical managed money, and how is it different? So tactical managed money is pretty simple. It's active professional money management, where total attention is paid by a money manager and not a rep. I'll come back to this. It gives you the flexibility to use multiple asset classes, following trends and indicators to select asset classes. They focus on the protection of assets in cash and other strategies as needed, and attention is given to asset preservation and appreciation. But I want to come back just to number 2 there for a second. Why is that important? Typically, if you sit down with a normal broker, advisor, they're going to build you a diversified portfolio, and that's going to be made up of a combination of stocks, mutual funds, bonds, that again fits your risk profile. The broker is going to do this with 500, 600, 700 people of his clients that he meets with during the year. And when you walk out the door, what happens to your portfolio? It gets stacked in the corner with another 500, 600, 700 people that he's meeting with. And when the market begins to turn negative, which one of those portfolios do you think is going to get the first call? If you're like me, I'm going to say the one with the largest account. And if you're number 400 in that stack, when does your call, or when did your call come in, if it ever did? And so for my clients and the students that I was working with, that approach simply was not good enough. So the question is buy and hold the best strategy for the client, or is it the best strategy for the broker representative who doesn't have the time to really manage and give attention to each client? So the basic goal of tactical money management is this: capture the majority of the upside performance and avoid the majority of the negative drawdown. So 3 illustrations. We're going to look at the S&P 500 3 different ways. Buy and hold, one where we capture 80% of the positive and then 80% of the negative we avoid, and then thirdly where we capture 90% of the upside and avoid 90% of the negative drawdown. So the S&P 500 buy and hold strategy from 2000 through 2013 would have turned $100,000 into $161,000. If you could have captured only 80% of the upside, avoided 80% of the downside, that same strategy would have turned into $270,000, just under. And thirdly, if you could have captured 90% of the upside while avoiding 90% of the negative, that would have turned into $335,000. Great in theory, perfect. But the question that I get when I'm talking with somebody is, can this be done? And the answer to that is yes, it can, because it has been done in the past. I'm going to show you two different scenarios of two different investors. Investor 1 is just a buy and hold investor. Investor 2 is actual performance of one of our money managers. Both of them are using indexed funds of some sort, tracking the S&P 500. So, investor number 1, well, this is over the last 15 years, his largest annual loss was negative 37%. Investor number 2, his largest loss was a minus 6.83%. Investor 1, his largest gain was 32.2%. Investor 2, his largest gain was 39.13%. Over that 15-year period, Investor 1 averaged just under a 6% rate of return. Investor 2 averaged 12.65%. Big, big difference. But what it boils down to is the bottom line. What is the ending account value? Investor 1, his account over 15 years had grown 83%. Investor 2, his account had grown 443%. Both indexed funds, both in the market, just two very different strategies. So the question that I ask person, if you are in your retirement years, you're drawing Social Security, you have a retirement income, and you are needing to walk out to that mailbox every single month to get a check, which one of these two accounts do you want that money coming from? It's pretty obvious. There's a big difference. I know which one I would want. I would want to be investor number 2. What are these two investors? Investor 1, any index tracking the S&P 500. Those are S&P 500 results. Investor number 2, that's the Weedco Power Dividend Index with their actual returns net of fees at being just under $550,000 over 15 years. That in a nutshell is what we do. Again, if you want to learn more about our strategy and how it might fit what you're looking for, give me a call. My cell phone number is listed. My email address is on here. I would love to chat with you and see what we could do. If you shoot me an email, I am going to also send you this free report that was published by one of our money managers, just the Volatile Market Survival Guide. And yeah, if you guys have any questions, fire away. Brad, if there's anything else, I'll just give it back to you, and you can get ready to launch. Thanks for the opportunity. Awesome.
Absolutely. Thanks for being here. Hey, would you shoot that Volatile Market Survival Guide over to me, Brad at reallifetrading.com?
I will absolutely do that.
Awesome. If you guys have any questions for Stacy, go ahead and type them in. He's going to be around to trade with us. And yeah, thanks for being here, Stacy. Barbara Hammond types in, thank you for doing that for us. Oh, I'm going to click the record button here. For those of you watching the recording, thanks for always trade on logic, not on hope. For more videos like this, go to www.reallifetrading.com.